So I'd like to welcome today's episode on Revealing Real Estate Podcast, a gentleman who is a very savvy investor in multifamily investments and runs his own syndicator or syndicate company who focuses on sourcing, underwriting, sponsoring, and capital raising for deals. He began his real estate career in software and technology, buying multifamily residential. He started first in smaller properties, focusing on finding vendors to repair, improve, and managing. Sounds a little bit about myself currently right now. And then shifting his focus on partnering with other ambitious real estate investors to acquire large properties. So I'd like to welcome to the show John Todderud. John, welcome to the show. Glad to have you.
Nick, thank you very much for inviting me. This is an awesome opportunity, and I really look forward to sharing some insights and experiences in the multifamily world. It's a tremendously exciting and rewarding set of opportunities, and look forward to digging deeper into topics that are that I think are relevant for you and your audience.
Yeah, and I appreciate that. And one of the reasons I wanted to have you on the show, John, was because I'm at the point within my career. I've been a real estate agent for 20 years here in Toronto. I run my own brokerage successfully with my wonderful wife. I've done a multitude of different investments in regards to real estate, whether that be renovating, building properties, being a landlord, right? It's fascinating to me about the syndication business or being a syndicator within the business itself. So I want people to understand, maybe if you could start off by giving us a little bit about your background story, which is very interesting, how you got into your business right now. And I'm definitely going to have a few more questions that I want to pick your brain about, if you don't mind.
For sure, for sure. I mean, Nick, you're in a great position to make a little bit of a transition, and it's hardly even a transition into multifamily. There are a lot of people that have done that, and really, people of such a wide diversity of skills and professions have skills and talents they can leverage to be successful in the multifamily world, and you've got a great set, being so strong in the real estate market already. My background started in had great IT jobs. I had software development, was working in small companies, managing other software engineers, and had my own business for a while, and then was a software consultant for a number of years. And through the course of that, I mean, you make decent income, and we were successful. I realized that what was most fulfilling for me was having control over the investments in my life, not just putting something in an exchange traded fund or a mutual fund or stocks or things like that. Those are great. A 401k, I did all that, and they were successful, and then sometimes they weren't, but there's nothing you can do other than study it even harder and try not to make the same mistakes again. But I like the idea of control. And so a few years back, about 13 years ago, was when I decided to buy my first properties. And I started small. It was like right down the road, a 3-unit property that was that had tenants, or presumably it did, but I wasn't educated in it, and I wasn't experienced, and I just knew that whatever problems I encountered, I'd be able to figure out, and bought into the property, and then needed to find tenants and write leases, and start making me repairs myself and driving down there to do that. And so I was taking the telephone calls during the day at my job. Super inconvenient, but managed to make it work. Bought another one similar to that, and then owned them several years, and did all found people to do the work. I mean, that was an early lesson, is that I can't do the repairs myself. I'm not even all that good at it, but it's not a good use of my time. And so my time was spent finding people to do these jobs. Eventually sold it, had a good amount of equity, bought larger properties, and through the course of all that, started going to multifamily conferences. I liked the multifamily industry, and I started going to conferences and meeting other people who did the same thing that I did and who were successful. They didn't have just a handful of units like I did. They had thousands of units, and they they seemed just like me. They weren't smarter or more assertive or aggressive or more outgoing or more anything than I was. And I figured this is something that I can do. I just need to learn it. And so I spent the time learning it. I took classes and became a licensed broker, just to add credibility to my background, and also took some coaching in the process. But I realized that buying larger properties, I mean, you start buying into smaller properties and you're putting your own money into it. Maybe you have a couple friends who are putting their money into it. Not long into it, you get tapped out, and you don't have any more money to invest in it yourself, but you still want to buy. You've developed a skill. You know how to look for these properties and figure out what a good opportunity is, and you've got a skill to do that. And so, how do you leverage that? How do you buy bigger properties? And it's clearly with other people's money, and people who recognize the value of a real estate investment just like you do, and they may not have the time or knowledge or experience or interest in talking to brokers and putting offers in and buying properties, but they do want to invest. And so those are people that have an interest in what you do. And if you're successful at it, they'll want to join you in buying a property, and you're effectively pooling other people's money. It's for the most part, it's syndicating. There are other variations of it, but that's pretty much what I do. It started syndicating, and then about 6 or 7 years ago, and then I've been syndicating larger multifamily properties since then.
Yeah. Has it always been for the same group, John, of investors, or have you expanded that to a big variety of different investors now that invest into your company?
It is expanded, definitely. The group of investors, if they invest in one of your deals, it's typically anywhere from $50,000 to $200,000, and they might not have a lot more funds that they choose to put in real estate until they can kind of see what it's like, what the performance is like, what kind of cash returns are they getting, and how is this operator, this syndicator, someone like me, actually doing in managing the property? Are they raising occupancy rates? Are they getting rent rates up? Are they able to distribute cash? All that stuff. And so they're not necessarily going to jump right into your next deal. And you got to, if you're out looking for more deals, you need to find more investors. And so there are, I mean, that's something I spend. I mean, any of us in this doing syndication will spend a fair amount of time trying to meet people who potentially might like to invest in apartment investments in multifamily, and because we want to do larger deals. There are good economies of scale in a larger deal. There's also a stronger sense of safety and risk mitigation in a larger deal, and that's really, it's my objective, and it's a lot of people's objective. Not everybody's, but a lot of people like to stay with smaller properties, and they have tremendous success in those areas. And for me, it's larger multifamily properties, and so they require more, a bigger team. And so there's two aspects you asked about. Are the investors the same? There's two aspects to it. One is the people who will invest the equity capital in order to make the acquisition. And then the second group of people are people who are going to manage the property with you. They are your general partners. And do you want what? I mean, it's a team sport. You're not going to do a syndication all by yourself. You need other people to help you. And I'm no different. There are things that I'm good at and things that I'm not as good at, but I can find the people who are good at these other things. And 1, 2, 3, 4 other people to join you in a management team. That's completely fine. And I've had good team members on my management team, and I always talk with more. I've not settled into one group of management team members, but I like the people that I've worked with in the past, and I would definitely work with them again. I just always have my ear to the ground, looking for more qualified people to work with.
I think one of and the reason why this is so interesting to me is because at the point of my life within my career is I'm looking, and I've been asked this many times, is why don't you start, a syndication and start getting investors. I'm very good at finding properties. I find wonderful opportunities based within my business, 20 years of experience. I run a wholesale company looking for wholesale deals that are below market value that need some work. We flip them, we turn around, and then put them back on the market, sometimes for a profit. Sometimes we're holding these properties for a little bit long term. But most of the time, and the majority of the investments that I made were for my own personal portfolio. And I always just went out there and used the bank's money, to the point where it's come where I want to continue doing this. I want to expand, but now I don't have the capital or enough capital right now to continue it on a larger scale that I feel like I can continue this at. And I want to learn the basis of actually starting. So having you on this podcast is a really good opportunity for me to really pick your brain quite a bit. So excuse the ignorance when it comes to the questions I'm going to ask you here. The properties that you guys look at and the opportunities that you guys would look to scope out, are these more for short-term in and out scenarios where you go in, you retrofit them, get new rental income from them, and then put them back on the market and flip them? Or are you guys holding this on a 5-year plan? How do you sell this to your investors?
Good question. It is a longer term hold. We having said that, it is analogous to a fix and flip to a certain degree, or most likely it's a longer term hold. I mean, so what you do in your work is difficult, and the fact that you've been successful means that you've gotten very good at it, and you can leverage those skills. As I was mentioning before, you can leverage those skills very effectively in the multifamily world, looking for good properties. That's not easy to do, talking to people and learning about them. What I do is mostly I'm looking for stabilized apartment complexes that have good occupancy. And what good occupancy generally means is over 90%. It's not a hard and fast rule, but when you get into that category, the types of loans you can qualify for are better. They're better terms and lower rates. And if you find a property like that, what I also look for is the opportunity to do something to the property. So even though it has decent occupancy, like 90-95% occupancy, it might have units that are old classic units, like linoleum countertops and carpets, appliances that are years old, and they're just occasionally upgraded when a tenant moves out and the property looks, or the unit looks bad, but there's no concerted effort for renovations to make something look real nice. And that's what I try to do. I look for properties where the owner has not done a lot to the unit, where there is an opportunity to not necessarily gut a whole unit, but to do strategic upgrades depending on the market and depending on what condition it's in already. Some markets you don't want to over upgrade, but I like to spend a few $1,000s on an upgrade. And knowing that I've already done my rent comp analysis, I've determined that the rents in that area, I could get this amount of rent by spending this amount of dollars, and here's the return I would project by doing all of that. I've got all that in an underwriting spreadsheet, and it takes some time to develop all that, but those are how I determine if it's a good deal or not. And when I get into the deal, hopefully I'm maintaining occupancy, but I'm renovating units as they become available, or I might just end a lease if the rent is really low, or particularly if it's an undesirable tenant, I'll just end the lease and go in and renovate the unit and lease it out at that higher rent. So now, having said that, I mean, those are typically longer term holds, and I would project a 5-year hold, but it could be 3 years, it could be 7 years, and the loan that we get can't expire sooner than that 5-year term. Preferably it's at least like a 7-year term or so to the loan before the amount becomes due. So in a 5-year period, we're owning that property. We're spending the time and effort on renovating it. In the first 1 year, 18 months, 2 years, whatever, however long it takes, hopefully not more than 2 years. It's typically less than a year and a half. And we're getting those units in a much better condition, and we're renting them out. Then we've got our income up, and we're operating that property. We're creating a solid community, and the cash flow is where we want it, and we're returning cash flow to our investors. They're getting cash distributions, and they like it that way. They want to keep receiving their cash distributions, and we want a stable property that.
Sorry, John, is those cash distributions, are they monthly, or is it yearly, or is it when you sell the property?
They are typically quarterly, and different people do it different ways. You can do a monthly distribution. I've been in some deals where they prefer to get money out on a monthly basis, but most of mine have been quarterly cash distributions.
But the principal investment always stays in. This is just
yeah.
If I came to you and I put in $100,000 into Cardinal Oak Investments, and you're going to give me kind of an analysis of, okay, we're going to look at this project. This is the value of it. These are what we can get the rental returns at by putting X amount of dollars inside there. This is what your percentage of profits will look like on a quarterly basis, and these are what your returns should come out at. Correct?
Yes.
Is that how it more or less operates to your shareholders?
It is. Yeah. And so you were looking at
enjoying this episode? Subscribe to our channel and leave us a comment down below to let us know what you want to learn next. Make sure you're following our Instagram and TikTok to stay up to date on our new episodes every Friday.
Really two ways for you as an investor to get your money back. There are two different ways that's being done. The first is the cash distributions, which is it's excess cash that the business does not need to operate. It's not like a company that's going to hold on to retained earnings and then invest in buying other companies or invest in new products or things like that. You're typically not going to do that in a multifamily asset. You might need to hold on to cash to do some major capital improvement or something, but typically you've built in cash at the beginning to do your major capital improvements. You're distributing that cash on a regular basis, hopefully quarterly or monthly or whatever it is that you've set out to do, and you tell the investor that at the beginning, this is what we're going to do. Then the second way that you get your money back is through a share of the profits when they sell the property. When the syndicator has chosen to sell the property, it is hopefully and almost always at an appreciated value. In recent months,
real estate in long term should always appreciate, right? The best times to buy are in the down markets, because it's only uphill from there.
It is, yes, and it's difficult to do, and you're seeing that today. It's like, I'm not going to invest in a real estate today because it's so far down and all of that. But the astute investor knows that that's really the right opportunity, the time to buy.
Is there a certain amount of investors that you'll put into one type of investment? Is there a cap that you'll do it at, or if you have 20 investors that want to invest, do you go out there and it's a twofold question? Do you go out there and find the property first, or do you raise the capital first, get your investment, and then go and look for what properties are going to be the right ones to fit for your?
You're effectively doing both at the same time. You're looking for properties, and you're talking to people who might like to invest. The model that I use, and this is not everybody's model, the model that I use is once I have spoken with investors and I know that they're interested and qualified to invest in a property, then I am staying in communication with them. They'll receive a newsletter and they know how to get a hold of me anytime, and I'll sometimes reach out and set up other meetings. Then I'm also looking for a property. I'm talking to brokers and I see a bunch of properties. I'm testing the financial analysis, underwriting, looking at the properties. And once I drill into one or more properties that I think I would like to buy, then I'm taking those steps to put in offers and then I start thinking about reaching out to these investors and letting them know that, hey, this property, I'm real interested in it. I've got an offer and I think I'm going to get a deal, or I might wait until I've got a deal to them. But if they're qualified investors and they're in my list, then they will hear about it and they will choose whether that's an investment that they want to put in at that time.
Right.
So they're not putting money in ahead of time. Other people have like a fund they're raising for, and then when the property comes around, they don't have to ask the investor. They've already got the money in the bank. Now, in my model, I'm asking the investor and I'm presenting the deal, and they're making a yes or no choice based on that deal, and then they'll put their money into that particular deal.
Got it. How does the financing aspect work, John? If you got, and I'm going to give you a quick scenario or an example. If we raise $1 million, we find a property that's valued at $2 million, need to get financing now for $1 million. Who gets the financing on the deal?
One of the general partners. And so before going into a deal, I'm going to know who the general partners are. If it's my deal, if I've gone out and found it, then there are I will have agreed to partner with one or more other people as the general partners, who will be the management team for the whole duration of ownership of this. And these are people I obviously need to know really well and have a strong trust that I can work with them over that period of time. So I needed to have known them for a period of time. And so the group of us will go in. One of us may have a particular strength in dealing with lenders and finding the right loan product. I have done that for a lot of my deals. I've also had a mortgage broker, highly qualified commercial mortgage broker as part of my team, and he has taken the lead in that for another deal. But I'm completely comfortable talking with the lending sources and analyzing and coming up with the right deal. But if I've got other general partners on a deal, certainly they have a say in it as well. It's not a solo operation, and I need their help, and I would elicit their help in doing something like that. And so we'll talk with, I like the mortgage brokers. I think they're great people and they're so knowledgeable. Other people go directly to a bank. They have a banker relationship and they can get a bank loan. And that's good too. I buy in other parts of the country. As I mentioned to you earlier, I'm from Seattle, but I don't buy in the Seattle or Northwest market. I buy in southern Midwest markets across the US. And so I'm not going to know the local banks in those markets, but I have mortgage brokers who know sources of funding for commercial real estate, and they have great terms. Typically, the agency, they call them the agency lenders, the Freddie Mac and Fannie Mae lenders. They are the lender of choice, the best deals if you qualify for it. And
no,
so
but yeah, no, I think the piece of it, and that's great. There's many different avenues of getting money, but I think I just want to know how title works, right? So if Cardinal Oak is buying the property under Cardinal Oak Investments, I'm assuming, is that how you do it? And then you have your
offer under that name.
putting the offer under that name.
Yeah. You're wondering how on like entity structures and things like that for buying a
just so that so let's say somebody who's listening to the show right now wants to start their own syndication company, and they want to start doing this and do exactly what you do, or maybe something that I want to do, and I wanted to get into the business and I'm just starting out doing this, and I have a group of investors that want to invest into my company, whether it be OP Team Investments, right? And I raised $1 million. Am I buying that product under OP Investments, and then having the group have ownership of that investment company as well? How does it work?
No. You will create a new legal entity for that. In the US, it's typically a limited liability corporation.
Perfect. That's what I'm looking for.
Yeah. And so you'll your offer. For me, John Todderud at Cardinal Oak Investments, my offer is going to say all that. It's just like, here I am, John Todderud, and Cardinal Oak offers you this amount of money, and pardon me. And in the offer, it'll say, before close, we will create an entity,
We'll
and
sign it.
and the property, everything will be owned by this entity, and it will be a single purpose entity. We're not going to use that entity, that LLC. LLC is the entity, and we're not going to use that LLC for anything else except this property. And so that's important from two aspects. One is the investors. The investors don't want to know that they're exposed to liability from other business you might have done, that you're going to take the money and go out and buy another property with it. But also the lender's absolutely going to require that. They're going to want to know that this is all you're doing with that LLC. You're not allowed to go out and do anything else. If you are, you're in violation of the loan, and they can call the loan. You do not want that to happen. And so you've got to obey their rules. And yes, it makes sense. From a liability, if you've got two or more properties and somebody sues you on behalf of one of the properties, then
Which
the
could not
extent
have
of
any
damages.
bearing on the other property, right?
Correct. Yeah. It's
Yeah,
just
makes sense.
protection. Yeah.
Yeah, no, that's great. What are some of the obstacles or some of the struggles that you faced early on within your business? Because I'm sure we all go through a little bit of that, right? Is there anything that you can share through your experiences that people should look out for, or maybe want to fast track their business to get to where you are at a little quicker pace?
Yeah. Getting training is very helpful. Look for a training organization that has well-developed modules for you to learn about syndication or about buying real estate. I didn't initially want to learn about syndication. I just wanted to learn about purchasing multifamily, but along the line, I realized that's really the direction we needed to go. That's one thing. A lot of other hints along the way. I have underestimated renovation costs, or what it requires to repair certain things early on, and gotten in a little bit of trouble with that. It's just not like major trouble, but had to put more money in than what I expected, and it's kind of a rude interruption. But
Those are tough conversations to have with your investors.
Yeah, and so well, I fortunately did that on properties of my own before I had investors. Once I had investors, I was further down the road and more knowledgeable and experienced, and there were people on my team that were helping me with this. We were getting qualified people to assess the repairs needed for a property before we bought the property, and I'm okay at that, but I'm not nearly as qualified as a lot of other people are. That's one thing. Another is buying in the right market. I've been in good markets, but my markets have improved substantially since I started. I mean, if you're in the Toronto area, and if you like Toronto, that may be a great market. I don't know the Toronto market. There are a lot of great markets in both the US and Canada, and I've chosen some of them, and somebody else says, well, what about this market? What about that market? And my only answer is I know those are good markets as well. It's just I've got to zero in on a few of them and become really knowledgeable and informed about these markets. And I've chosen these for now. Not that I wouldn't add another one in the future, but you really need to know your market and choose ones that have the right attributes to them. They need to be population growth, jobs growth. Look at the household incomes and housing prices, and are companies moving into them, and what's the population, and a few of these metrics, crime rates and things like that. And it's not just the big city, it's the submarket around that city that is most important to you, that will determine your success or failure in that property, really, because whether you can get tenants or not, tenants not going to come into a property that's in a war zone area, where there's graffiti around, where there's a lot of other shady businesses, where that
crime rates up.
Yeah, high crime. That's a deterrent for sure.
Yeah, no, for sure. And then how do you set up, John? I'm sure there's a management fee, a management cost through the process, right? Your time is valuable and you can't do it for free. What do you normally charge for managing these projects for the investment group?
There are some fees involved. Ideally, if you're a passive investor and you want to invest with a syndicator, like myself or like a lot of other ones, you want to know that the syndicator's interests are aligned with yours, and so the syndicator should get paid after the passive investors, the limited partners, are paid. And so the structures of these deals are typically that the first X amount of cash flow that it produces in that quarter goes to the limited partners, the passive investors. Then if there's more, then maybe it all goes to the general partners, or maybe a portion goes to the general partners and a portion goes to the limited partners. There are different ways of cutting all that up. That's one way that the general partners can earn fees from doing this business, is by operating well, by doing a good job at the operations of the apartment. A lot of properties, and I've done this also, will also charge an asset management fee. And so asset management is different from property management. Property management are the people that are on site, that are day to day. They're taking the phone calls to fix issues, they are collecting rents, they are finding new tenants, and all that day-to-day operations. If you're a tenant and you got a problem, it's the property manager who you need to call. The asset manager is the ownership team, the managers, the general partners on the ownership team, who are deciding things like how many units should we be renovating, how much should we spend on a renovation, what kind of finishes should we do on these renovations, do we want high-end granite countertops, or is that too much for this particular market? Making decisions if you have capital improvement or capital expense funds, and there's a problem like with the roof or the gutters or with overhanging trees or with various things like that. Where do we spend the money? Your asset management team should be determining that, and they're going to be on the phone with your property manager on a regular basis. It might be weekly or even more frequent than that, or maybe bi-weekly, depending on the condition of the property. And they're getting paid a fee, and it might be 1 to 2% of the rents that you're getting, in order to keep performing that. If you, as a passive investor, you want to know that your general partners are focused and are doing well by owning this, that they're not just losing interest because it's experiencing some problems, and so we're not as interested in it anymore. And they're gonna, I mean, they're not that they're gonna walk away, but they might be less motivated than otherwise. You need to know that there is some compensation there for them. They're not going to get rich off of asset management fees, and it's not ripping off limited partners at all. Their big payday is when they sell the property. They've got to get the value of that property up, and it's got to be over and above the passive investor. First, the passive investors have to do well, then the general partners can do well. And
yeah,
so
and I think that's the big key, right? Is making the money over time through inflation, where when you sell that property, there's a good spread out for the investors and for the for the passive investors for it. What are some of the returns that somebody through your company, John, will make? What are the returns look like for someone?
We are typically projecting returns of about an average annual return of about 20%. And so for a 5-year period, you should double your money between cash flow and the appreciation of the property. You should double your money. We've done better than that on average. And we try, I mean, everybody says this and everybody tries to be, we try to be as conservative as we can. And in terms of what our projections are, but these aren't guarantees. The cash distribution amounts might be 6, 7, 8% or so, and depends on deal by deal. Which means if you invest $100,000 in a deal and the preferred cash flow distribution return is 7%, then assuming that the property is producing this much cash, you would get $7,000 through the course of that year. That's just your cash return. That's not appreciation, and that does not reduce your total capital investment. You still have the same amount of equity that you started with. It's just cash return, and then you'll get a share of the equity, the appreciation, when you sell the deal as well.
In these situations, John, are you give or provide any guarantees on a return?
I don't. No,
Okay.
and I don't know how anybody can. I've heard about a guarantee.
Because markets go down, right? We're in a market where interest rates went up, values have come down.
Yeah.
As long as it's producing cash flow, I think, you can determine based on an approximate return on the investment for that monthly income that property will generate. But you can't predict markets, right? Whether the market goes up by 10% per year or 5% per year or 20% per year.
Yeah.
So
a legitimate operator is not going to offer a guarantee. If you hear that, you should be super skeptical about what's going on behind that. How can they do that? What's backing up their guarantee? The credible operators just have a track record that you should look at. Like they've not done capital calls. They've not lost investors' money, returned properties to the bank. Maybe they had a property that they projected 20% and it only returned 12%. That's not a deal killer. 12% is a good return, not what you were expecting in one case, but it's still a good return. And hopefully their average is over 20%, looking at a deal. But you look at all those things, you assess the operators and what their team looks like, their experience, and have they gone full cycle in deals? Meaning that have they sold some of the deals that they bought, or are they brand new and still buying deals, and they still might be good, but
this may be a dumb question for you, John, but how do you guys determine when you're going to sell a property?
It is several things. We start off ownership of every property. Well, actually, even before that, looking at a property, in order for us to decide that it's something we want to buy and put a team together and look for investor capital on it, we need to know what we're going to do to that property to improve value. So it becomes a business plan, a business execution plan, and that execution plan is communicated to the investors. This is what we're going to do. How we're going to do it. We're going to invest whatever $6,000 in renovating a unit, and we'll be able to add $150 a month to the rent after we put it back on the market, whatever those numbers happen to be, and therefore they produce this return, and that all of that information is in your business plan. A lot of times you're out there renovating units, and you have reached the goals of your business plan before 5 years. You're maybe 3 years into it, and let's go back to say 2020, 2021. There was an excited excess demand from buyers for multifamily properties. If you're in the middle of that kind of a market, you might decide, wow, now's the time I should really be selling, because this is I'm going to get top dollar and return money to our investors, and they can go put it in something else, or they can sit on it for a little while, but we're gonna sell it now as opposed to wait for 5 years. Other times, like if you've got a property now and it's cash flowing and doing well, you might have been thinking of selling it because you executed your plan, but it's a difficult market today. As you know, the interest rates are up, and investors are skittish, and it's difficult to find a buyer for a property today, and so you might choose to hold on to it for a while, whatever that number is, 6 months or a year or 2 years or something like that.
But who collectively decides? Is it a group decision at that point, or would you, as being the president of Cardinal Oaks Investments, say, okay, guys, I think this is the right time. We've hit our projections, our numbers. We've arrived to our numbers. I think it's time for us to put this on the market.
The management team collectively decides.
Okay.
Yes. It is the limited partner investors, passive investors, They don't have a say in management. Having said that, though, smart general partners know who their passive investors are, and there's likely a lot of them that have experience, and there's no reason that you can't call up some of your passive investors and say, hey, we're thinking about this, and what do you think? Should we hold on to the property, or should we take a take a little bit lower of a price today? Would you like your money back? Or just kind of feel out your investor base. If you've got a small enough number of investors, that might be a great way to go. If you got 50 or 100 investors, it's really impractical to do that. But the management team needs to be qualified to do that. And really, if you've got one or two people on the management team who are just adamant that this is not the time to sell the property, it is best not to sell. You shouldn't be just taking a vote and moving forward and saying, well, sorry, we overruled you. Your management team really needs to be together on these things. And if you haven't persuaded the rest of them that now's the time to sell the property, then maybe you haven't done a good enough job, and maybe there's not a good enough justification to sell it. You've got strong, smart people on your management team. You should expect critical feedback from them.
Yeah, this is pretty good, John. Given some really good, insightful information, especially for those that want to look at some new opportunities. Because I do believe, as the market that we're in Toronto right now, Canada has a really large volume of immigration coming within the country. We're bringing in about 450,000 immigrants per year, and those projections are set to take for the next 10 years all the way to at least 2030 for sure. And a lot of those immigrants actually end up coming to Toronto and Vancouver are the two main kind of cities that they'll actually go to actually start their residency and start, building a new life. So multi-family is huge. Now the city is looking at, because of the amount of immigration, to get these multi-doors come in, where if you have a rear lane garage or a garden, you can build, or a garage within the backyard of the property, you can make that into a garden suite and generate multi-dwelling family units. And those are going to be moving, really rapidly. And I think if I was to start one of these syndicate companies, I definitely will look at those opportunities there that can generate multi-family incomes, where nowadays, with homes being so expensive and we're in a little bit of a housing crisis because of values, to look at those opportunities where we can put a daughter or son that doesn't have the capabilities or the financial backing to move out on their own and still need to live with their parents, where the parents could still invest within the rear of those backyards, and finding those properties for people to start buying. And this is something that I've been thinking about, and just, it's hard to get started. I think once you get started and I get my feet moving, people ask me all the time, hey, Nick, is there any way I can invest with you and get into some of your deals? And I just never, I was just always in the rat race of selling real estate all the time, right? And just dealing with my own products. I never really thought outside the box until, the past, few months that I've been looking to put this together and start my own syndication, really, and becoming a syndicator for sure for a lot of potential clients that I deal with on a daily basis. So how was it at the very beginning for you, John? Was it difficult? How did you start with your first deal? Do you remember your first deal?
The first property that I bought, was right after the 2008 crisis. I was actually looking for properties before that, 2006 or 7 or so. Went out and had talking to friends and driving out to properties and seeing them, but just never, fortunately, never ended up buying one. I mean, not because I thought, oh, there's a big crisis coming. I didn't have a feel for that. It's just that there were not good deals. And so 2008 came, the market crashed 2009, and it was still down around that time period, 2010 or so. I decided, well, it's been down for a while, and I don't know if it's going to keep going down much further, but probably not. And it might even be flattening out or starting to take off. Who really know? You look at the market as best as you can, and you have to get off the fence. You have to make a decision and do something. And so that's what I did. My first property was 2010, and it was small enough that it was just myself, my family money, and getting into it as kind of a learning experience, but also knowing that I can make something good out of that. And really the second property was the same way. There were 3-unit and 4-unit properties, and not too far away from me. I figured I can have good control over those. How I got into syndication was, like I mentioned, is learning about it. What's the whole model about? There are legal controls around it. I needed to learn about investors and about the legal documents that are involved, private placement memorandums, and subscription agreements, all that kind of stuff. You need to know what that's about. You need to find good attorneys and build your other team. And so there's a lot of those things that you have to put in place. And yeah, I didn't know. I mean, you learn about it a little bit at a time, and you have more questions. You just need somebody to call and talk to. You need other people who can mentor you or coach you, or at least have been through the process before. That's probably the most critical thing, is that you need a team. You need people to call and, like, what do I do at this step? And I got asked about this or that, and what should the response be? And should I go forward with this deal? All those things. You need a good sounding board, people who have been through it. They help tremendously, and I can't imagine doing it without people like that. But getting started, yeah, you're nervous. You're nervous that what if I've spent all this money on things like a building inspection and earnest money deposit, and even now the legal agreements, and I'm raising money from investors, and I can't raise enough money for some reason. Couldn't quite raise all that money. Well, I'm not going to get those other funds back. Those are sunk costs, and I would just lose them. And so that's a highly undesirable situation to be in. And and so you need to take precautions for it. Make sure you can raise the money. Have your contract set up so that you get your earnest money deposit back, or certain things like that. Or what if, like, over the last 6 months or so, interest rates have been climbing, and from the springtime, every couple of weeks it's a little bit more, a little bit more, a little bit more. And you put a property under contract, you've got an agreement from a lender, you got a quote, even a term sheet from a lender for a interest rate and a loan term and proceeds, the amount of money you're going to get on that loan. But 2 weeks into it, they call you up and say, it's going to be worse now. The rate is higher, the proceeds are lower. And meanwhile, you've got this property under contract, you're trying to work through it. And man, it is just it's undesirable way to be. You're in a situation where you got to go back to the seller, maybe retrade. I mean, retrade is an awful term, but it means that you're going back with a different offers in order for me to buy this property.
Yeah,
you got to sell it to me for less money, because that's what's happening in the interest rate market. And so those are agonizing situations to be in, but you got to realize there's a solution to it all. Maybe you walk away, or maybe you can get a better deal from the seller. There is a solution out there.
Was there ever a bad deal that you didn't like?
Oh yes, yeah. In fact, I had one. I did syndicate a deal in upstate South Carolina, and it worked out well. We bought it and owned it for a while and sold it, and our investors did well. Prior to buying that deal, I was looking at another deal in upstate South Carolina, and it was, I knew it needed a lot of work. I couldn't really tell based on discussions with the broker and other people who went to that site. And so I put in an offer and had pricing agreement and had it under contract and did a walkthrough. I mean, I visited the property, did a walkthrough, and that property was just falling apart. The floors were warped. It was like walking through one of these haunted houses or something. It was just crazy, because different posts underneath the flooring on the first floor were sinking at a different rate than others were. But they still rented it out. It was mostly like 90-95% occupied, but these people, they were paying a really low rent. They didn't care what was going on. They knew they were getting a smoking deal. And I walked through it and had a couple contractors walk through it, and the estimates that they put in for it were more than what I was paying for this property. And I thought, man, you should just take this building down and build a brand new one. It's not something I do, but I had to walk away from it. I mean, I spent some amount of money, not huge amount, but took a trip there and walked through it and saw things that were just something I couldn't work with. I don't do that kind of thing. I'm not a super distressed property buyer. I don't.
Yeah, and I think that's what the importance is of somebody wanting or wanting to invest with somebody like yourself who has an eye and has the experience of finding the right deals to get the right return. And there's a lot of people that work every day doing a full-time job, and it's not what they do every day. And they need that guidance and they need that investment. And to me, I think the safest, most sound investment that you can make within the market is within real estate, no matter what country you're in or no matter what market you're in.
Yeah, I completely agree.
And it's better than for me in investing into. I'm not a big stock guy, or I don't buy gold or oil as much as I want to get within those markets or try to. You hear all these wonderful success stories where you're making 200% upsides in a matter of a month. Maybe that's not going to happen within real estate, but I think in the long term you're always going to win, and I think that's what's most important. John, listen, you've been wonderful. I think we've talked maybe for over an hour. So I definitely would like to maybe get a second part to this one day and get you in for another second episode on this. You've been wonderful. I want to thank you for coming on the show. You brought some wonderful insight. But I don't think I'm done with you yet. So there's a few more. I think I can get at least another episode out of you for sure. And I'll get my team to reach out to you to schedule another date if that's okay.
For sure, I would love to. It's been a fun conversation, and a conversation like this, we're just scratching the surface. There's so much we can dig into in any one of these different areas, and I think it's hard. There's so many different aspects of it. It's sometimes hard to tell which one I should spend more time on. But yes, I'd be glad to dig into any of these topics and just drill deeper.
Yeah, and I guess people that are listening, if they wanted to invest into Cardinal Oak, they can definitely have that opportunity.
Yeah, for sure. The best way to reach out to me is through a website. It's learnaboutapartments.com. Just learnaboutapartments.com.
Yeah,
and you'll get to my website. A way to enter contact information and all that. Learn about.
You offer any mentorship or guidance to get people to start their own syndication companies?
I do not myself. I mean, a number of people that I've met along the line have asked me if I would help them, and I'm completely open to it. I'm glad to get on like a recurring call schedule and see if I can help somebody and bring them along to their next step. And yes, I love doing that. I don't have a formal program, and I definitely don't charge anything for things like that. But it helps me to know that I'm helping other people. I mean, you starting off.
I appreciate that. You're a gentleman for that. That's awesome.
Yeah. We've all had help. I've had help from such experienced people, and they're there to pick up the phone and call, and it's the least I can do to give back to other people who are starting.
That's amazing, John. You seems like you're a great guy. I just met you right now, but I think I like to get to know you a little bit more and really understand this avenue, this aspect of this different venture of something that I want to start getting into, because I think I can help as well. People make a lot of money, and I think that there's going to be a lot of upside as interest rates do start to come down. Eventually, they will. I think there's going to be a lot of opportunity, and if we can start generating some investors and get liquid and get into the right deals within the next 4 to 6 months, I think the investors that we'll put into our group will definitely flourish and be very happy with the outcome and the returns that we'll be able to provide, right? And that's what that goal is for me, most importantly.
Yes, Yeah.
My team will definitely reach out to you again, John. I thank you for coming on. It's been a pleasure, and you've been wonderful to have on the show. Thanks
Well,
again.
thank you, Nick. I look forward to talking again. Yes, it'll be fun.
Awesome. Looking forward to it. Take care.
Thank you.
Looking to buy or sell? Call a team you can trust. Don't believe me? Our Google reviews say it all. Put us on your lawn, your house will be gone. TheOPteam.com.